Think you've caught up on markets this week? Think again. This is the weekly market update, where two generative AIs, guided by a former senior portfolio manager, break down what really moved the markets and why. No spin, no fund to sell, no political filter, just sharp macro insights, global market context, and the real story behind the data. It's a front row seat to how AI is changing finance right now. Like what you hear, then like, share, and subscribe, because you won't find this level of clarity from your bank or your favorite finance influencer. And trust us, the last 5 minutes might just change how you see the week ahead. Let's get into it.
All right, let's dive into the global markets for the week, ending August 29th, 2025. And what a week it was. Definitely not the sleepy end to August some might have expected. We saw this real convergence of inflation data, geopolitical uncertainty, and central bank moves all kind of stirring the pot. Wouldn't you agree?
Oh, absolutely. What's fascinating, I think, is how these different threads, seemingly separate, they all came together at once. It created this really dynamic environment, from inflation surprises over in Europe to, well, a very public challenge to central bank independence right here in the U.S. There's a lot to unpack.
And that's exactly what we're going to do. This deep dive is your shortcut to understanding the critical shifts across the U.S., Europe, Japan, and China. We'll break down the key events, look ahead to what's coming next week, and pinpoint those top 5 risks you really need to have on your radar. Expect a clear, engaging rundown of a pretty complex week. So let's kick things off with the U.S.
Okay, the U.S., it felt like a bit of a tug of war this week, didn't it? Equities overall were slightly down. S&P off -1%, NASDAQ down 0.2%. Dow also slipped 0.2%. But interestingly, small caps, the Russell 2000, they actually gained 0.2%. That's what, the third week in a row they've outpaced large caps?
Yes, third week.
Yeah.
And all on pretty light volume, too. Ahead of the Labor Day holiday, people maybe squaring up positions.
Makes sense. But beyond the headline numbers, that NVIDIA story just keeps going. Another earnings beat gave the NASDAQ a temporary lift before Friday's pullback. It definitely keeps that AI narrative going strong.
It does, but it also brings up that question again, doesn't it, about how sustainable this rally is if it's so reliant on a few big tech names, especially, with potential headwinds coming. What's your read?
That's a really critical point. I mean, AI optimism is there, but yeah, the concentration risk is undeniable. But honestly, that wasn't even the biggest drama this week, was it?
No, not by a long shot. That Fed news was something else.
Right. President Trump firing Fed Governor Lisa Cook. I mean, that's pretty unprecedented.
Highly unusual. Challenging the Fed's independence like that. It immediately kicked off a court battle.
Exactly. And it raises huge questions about institutional credibility, adds a whole layer of political heat onto the Fed.
And connecting that back to policy, we also heard from Governor Waller again. He reiterated his call for that 25 basis point cut in September, pointing to the cooling labor market.
Yep. And the futures market is certainly listening, pricing in, what, an 89% chance now?
89%. So you've got this real tension, right? The Fed signaling easing, but facing these big institutional challenges. It's a test of market confidence.
It really is. And it poses that question. How much can the market price in those cuts before concerns about Fed independence just take over? It's a fine line.
Definitely. And on the data side.
Well, core PCE inflation, the Fed's preferred measure, came in steady, 0.3% month-on-month, 2.9% year-on-year, unchanged from June. So that, keeps the door open for easing, which the market clearly wants.
Okay, so inflation holding steady, but GDP got revised up.
It did. Q2 GDP revised up to 3.3% from 3.0%, showed stronger consumer and business spending than first thought. So a bit of a mixed signal there, maybe.
And maybe reflecting some underlying anxiety or just those inflation concerns. Gold went wild.
Absolutely wild. New record high.
Totally.
$3,518 an ounce. That's 31% up year to date.
Wow. 31%. That's more than just inflation hedging, right? It feels like a flight to safety, maybe some nervousness about that Fed situation.
Could well be. It points to a deeper market unease, for sure. A move towards traditional hedges when things feel unstable.
And jobs. Weekly claims dipped a bit, but the focus is really shifting, isn't it?
Totally. All eyes are on that big payroll report next week. The labor market is absolutely key right now.
So for you, the listener, the takeaway in the U.S. is this kind of push-pull dynamic.
Yeah.
You've got cooling labor and PCE data suggesting easing.
Right, but then you have robust GDP and record gold prices pointing to, well, persistent strength and maybe some lingering inflation fears.
And all this playing out under increasing political pressure on the Fed. That labor report next week, It's going to be huge. Your perspective needs to be really nuanced here.
Absolutely pivotal.
Yeah.
Okay, should we jump across the pond?
Let's do it. Europe. Felt like a tougher week there. Definitely a contrast to the U.S. in some ways.
Yeah, much tougher. Sharp falls across the board. STOXX 600 down almost 2%. DAX off 1.89%. CAC 40 in Paris really took a hit, down 3.33%.
Wow, over 3%.
And the FTSE 100 in London dropped 1.44%. It seems like that Fed uncertainty spilled over, plus a stronger euro didn't help exporters, and then hints the ECB might just sit tight for now.
And inside the ECB, it sounds like there's a real debate going on.
Oh, definitely. The minutes from their July meeting showed a clear split. Some members worried about growth slowing down, others still really focused on inflation sticking around for longer.
That kind of division makes it hard for them to give clear signals, doesn't it?
Yeah.
Leaves investors guessing.
Exactly. And then you had those inflation numbers kind of complicating things further.
Right, the surprises out of Germany and Spain.
Yeah. Germany's harmonized rate ticked up to 2.1%. Spain held steady at 2.7%. Those numbers certainly don't scream cut rates now.
So sticky inflation in key economies, even with growth concerns bubbling up. How long can that divergence last?
That's the million-euro question, isn't it? We heard whispers from anonymous ECB folks around Jackson Hole suggesting a September pause is looking likely. Cuts could still happen later if the data really rolls over, but for now, maybe a hold.
So Europe's kind of caught then, between stubborn inflation and these internal ECB disagreements. Makes them seem a bit vulnerable.
Very much so. If you connect it to the bigger picture, they've got this dual threat: weak domestic growth and potential external shocks. It makes the ECB's job incredibly difficult.
And speaking of shocks, you mentioned France was feeling some pressure too. Political stuff.
Yeah, political instability there, plus ongoing worries about the Ukraine situation. That just added to the risk-off mood.
And over in the UK, that retail story sounds pretty grim.
Grim is the word. 11th straight month of falling sales, according to the CBI survey. That's not just a blip, that's a serious downturn.
11 months.
Yeah.
Yeah, that's a trend. So for you listening, how did these European dynamics, especially that UK retail weakness, factor into your thinking?
It hints at broader challenges, doesn't it? It's not just about people buying less stuff. It suggests the whole economic engine is struggling. That could definitely hit company earnings down the line. Something to watch closely.
Okay, let's shift gears again. Japan. Felt like a bit of a puzzle this week. Lots of mixed signals.
Very mixed. Equities diverged, Nikkei up slightly, 0.2%, but the broader TOPIX, down 0.83%, seemed like investors were juggling month-end rebalancing, those conflicting data points, and maybe a slightly shifting tone from the Bank of Japan.
And the yen and bond yields, still elevated.
Yep. Yen stayed around 146 to the dollar, and 10-year yields held near that 1.61% level, which is, a 17-year high.
17 years, wow. Shows how much pressure is building against the BOJ's usual playbook.
Absolutely. And Tokyo's core inflation, while it's slowed a bit to 2.5%, is still running ahead of the BOJ's 2% target.
Right. But then adding to the complexity, the jobs number looked really strong.
Yeah, unemployment dropped to 2.3%, lowest since 2019. That definitely strengthens the argument for, maybe tightening policy a bit.
But then industrial production went the other way.
Exactly. Fell 1.6% in July. That raises concerns about demand from overseas, about exports.
So low unemployment says hike, weak production says hold. That's a tough spot for the Bank of Japan.
It really is. They've been trying to escape deflation for decades, and now that inflation is here, global headwinds are making that exit strategy really tricky.
So the big question for them is, do they edge closer to a hike, trusting the domestic strength? Or does the global uncertainty make them pause?
Precisely. And their decision matters globally, given their history of super loose policy. For you, this is a key economy potentially nearing a major policy shift. Worth watching closely.
Okay, finally, let's talk China. Markets there continued their run-up in August, didn't they?
They did, on the mainland at least. CSI 300 up 2.7%, Shanghai Comp gained 0.84%. But Hong Kong's Hang Seng actually lost ground, down about 1%.
So the driver seemed to be liquidity again, not fundamentals.
Very much liquidity-driven, and fueled by retail enthusiasm. The really striking number was margin debt.
Oh, yeah. What was it?
Hit its highest level since 2015. That screams retail speculation, people borrowing to buy stocks, likely because deposit rates are so low.
2015 levels. That's quite a signal. Feels like liquidity is driving the bus, like you said earlier, rather than solid economic news.
Exactly. There's a real disconnect. If you link it to the bigger picture, this rally is kind of papering over some deeper economic weaknesses.
Because the other data wasn't great, right?
Not really. Industrial profits fell, though maybe less than feared, helped by tech. But July's retail sales, factory activity, investment numbers, they all disappointed.
Which just reinforces those expectations for stimulus, I guess.
Absolutely. Most economists are now looking for targeted easing in September to cushion the blow from U.S. tariffs and that sluggish domestic demand. The market is clearly betting on significant stimulus, but, the question is, will it be enough to bridge that gap between the weak data and the high-flying market?
Right. So for you, the listener, how long can a rally like this build more on hope and speculation than hard numbers actually last? What does that say about China's stability?
It's a crucial question. The longer that gap persists, the bigger the risk of a sharp correction if the stimulus doesn't meet those very high expectations.
Okay, so that's the whirlwind tour of the past week. What's on tap for the week ahead, September 1st to 5th?
Right. Pivoting into September. Let's look at the key data points for you to watch. In the U.S., Monday is Labor Day, so markets are closed.
Good reminder.
Tuesday, we get the ISM manufacturing PMI and construction spending. Wednesday brings JOLTS job openings and factory orders. Thursday is busy. ADP jobs report, ISM services PMI, productivity and costs, trade balance, and the usual weekly jobless claims.
But the main event is Friday, isn't it?
Absolutely. Friday, September 5th. Non-farm payrolls and the unemployment rate for August. That's the big one everyone's waiting for.
Definitely front and center. What about elsewhere?
Eurozone gets flash inflation for August on Tuesday. Key number after this week's discussion.
Right.
UK has retail sales for July out on Friday. We'll see if that grim trend continued. And China kicks things off on Monday with the QUICKSAND manufacturing PMI for August. An important early read.
So mark your calendars for those. That U.S. jobs report on Friday and the Eurozone inflation on Tuesday feel particularly crucial this week.
Agreed. They could really confirm or contradict some of the narratives we've been talking about.
Okay, now for the part where we talk about what might go wrong. What are the top risks keeping strategists awake at night? For you, these are the 5 key things to monitor next week.
All right, risk number 1, a U.S. jobs report shock. After that really weak 73,000 print in July, markets are definitely on edge. Another bad number could seriously amplify recession fears.
And potentially force the Fed's hand on cuts, maybe even before the September meeting.
Exactly. That's the risk. So watch that Friday report very closely. A big miss could trigger a major reaction.
Okay, risk number 2.
The Fed independence crisis. That whole political drama surrounding Lisa Cook's firing isn't just noise. The risk is that any further politicization could seriously dent market confidence, push yields higher as investors demand more compensation for uncertainty, and spark a flight to safety.
So we need to watch for court rulings, statements from Fed officials.
Precisely. It's a legal and political situation with potentially big economic consequences.
Brought it. Number 3.
Eurozone inflation resilience. We talked about this. If inflation in places like Germany and Spain stays sticky, it could force the ECB to hold off on cuts, even with growth slowing down.
And if Tuesday's flash CPI confirms that higher inflation,
then rate cut expectations get pushed back and European stocks could take another hit. Watch that Tuesday data.
makes sense. Risk number 4.
China's stimulus timing. That liquidity-fueled rally needs fundamental support soon. The risk is simple. If Beijing delays stimulus, or if what they deliver feels underwhelming compared to market hopes, you could see a sharp pullback in Chinese stocks, especially with margin levels so high.
That case in PMI on Monday will be an early tell.
Yes, it will.
And finally, risk number 5.
UK retail pain deepens. That sector is in its worst slump in over a decade. If Friday's July retail sales data confirms things are still getting worse, it raises recession flags and really ties the Bank of England's hands. How do you fight inflation when the economy looks like it's stalling?
Yeah, tough spot. These are really critical vulnerabilities, aren't they? And they're all connected in this global web. Any one of them could be a trigger.
Absolutely. And what's key for you, the listener, is understanding how they connect. A shock in one area can easily ripple through the others now.
Right. So understanding these risks isn't just about dodging losses. It's about spotting potential shifts before everyone else does. How might a bad U.S. jobs number change China's stimulus plans, for instance?
Exactly. It's about thinking through those second and third order effects.
Okay, so wrapping up, we're heading into September with markets feeling pretty anxious, wouldn't you say? Worries about central bank credibility, the labor market, geopolitics.
Definitely elevated anxiety. And this tension between liquidity keeping things afloat, especially in China and parts of the US, versus the underlying economic softness. That feels like the key dynamic.
And that U.S. payroll report on Friday really could be the inflection point, the thing that tips the scales for Fed expectations and market sentiment.
It's a huge test for the market's optimism, particularly its hunger for rate relief.
So the final thought for you to mull over: what if some of this market optimism is built on shaky ground, on quicksand? What happens when the data comes along and challenges those assumptions? How will you position yourself for that potential reset?
Lots to think about. Keep watching the data. Stay curious.
And thanks for joining us on this deep dive. We'll be back next week to unpack whatever happens next.
Always more to learn, always more to connect. Until next time, think critically about the real drivers behind the numbers.
Still watching? Then you're one of us, someone who actually wants to understand the markets. If this helped you think sharper, tap like, share the insight, and hit subscribe. Smarter markets need smarter minds. Let's grow this together. New AI-powered episodes drop every week. Imagine this format: AI-powered, sharp, fast, built around your industry, your firm, your market. For investors, leaders, or teams that move fast, we create custom podcasts designed to inform and impress. Curious? Contact us to build yours. Bespoke, bold, built by Flamingo's Research and Advisory.